Thank you everybody on the call, on the webinar. Good evening to everybody, whoever's joined in from India or the Southeast Asia or the Asian side. Good afternoon to the guys who've come from the European side, and good morning to the guys from the Northern America, the American side. I'm thrilled and delighted to host this session for Dr. Arvind Rajan. And before I get into introducing Dr. Rajan, may I spend a minute on your host, that's myself, Jayan Shah. For last 18 months, I have decided on my entrepreneurship journey, and I'm enjoying that. Started the enterprise called Mavuka Capital Advisors Private Limited in December 2018. Predominant activity in last 18 months, 19 months has been around the credit markets, gathering much needed resources, debt funds for variety of clients. Been able to close out 8 transactions in last 12 months, 13 months. And prior to that, I had interesting journey across various organizations. Last role was with IDFC Bank as head of debt capital markets. During those 7 years at IDFC Group, proud to hold the India Bond House Award of IFR Asia 2015. Then in 2016, held or collected 2 awards for the best local currency bond deal in India. That was for a leveraged buyout deal of Lafarge assets. During IDFC, of course, there were a lot of first of its kind deals in India, bond deals in India. Prior to 2011, have worked with Standard Chartered, Royal Bank of Scotland, Rabo, ABN AMRO, and Kotak Mahindra. I started my professional journey in 1995 in the bond markets as a fixed income sales desk. I borrow Dr. Arvind Rajan's quote, "I am not a bond, but a banker on a move." So all this 25 years I've been associated with the bond markets, and that's why I'll take a pause. Let me share with you and give you the illustrious background of Dr. Rajan. Thank you, Dr. Rajan, again to be on our call, on our webinar. And I'm sure our friends in the CFA Society India will learn a lot from today's session. Prior to getting on his own, Dr. Rajan, about few months ago, and I had the opportunity of being along with him in the December Chennai conference, which was CFA Society's first of its kind attempt to set up a fixed income conference day in Chennai, and that I hope will become a calendar event year after year. Dr. Rajan was managing director and head of global and macro at PGIM Fixed Income, looking after global bonds, emerging market, investment strategies. He also in 2015 was appointed as adjunct full-time professor at NYU Stern School of Management. He's worked with PGIM for long years, and prior to joining Prudential Financial Group in 2008, Dr. Rajan worked at Citigroup, where he was co-head of US fixed income strategy. During 2003 to 2006, he was the global head of emerging markets quantitative research and strategy for the fixed income division at Salomon Smith Barney. And prior to joining the Salomon brothers in 1994, he worked at AT&T Bell's Labs, and he also taught at Rice University. He does hail from India, from Chennai's IIT, and went on to do his PhD in operations research at Northwestern University. During this COVID times, he has finally got some time to watch some of his favorite classics on the live streaming media and other platforms. With that short introduction, I hand over the floor and rest of the day's proceedings to Dr. Rajan. Dr. Rajan, welcome again on our webinar, and over to you.
Jan, thank you so much for that very flattering introduction. It's such a pleasure to be back in front of CFA India again. I greatly enjoyed my trip last year, and it's very nice to talk to all of you. But so much has changed in the last 9 months, and I'll try and share with you how my perspective of bond markets has evolved as a result of that change. As we get started on this, I wanted to begin really with one of my favorite quotes from Victor Hugo. No army can withstand the strength of an idea whose time has come. And the reason I put this up is not only did I make this the mission part of the mission statement of my own new startup since I left corporate life, but it is in many ways a metaphor for what COVID has taught us. You know, when something as large as COVID comes along, all of the standard beliefs, the frameworks that we've used to think about things may need to be thrown out the window, and we may have to rethink how we not only deal with the virus, but also to deal with the changes brought about as sort of a secondary effect of the virus. So in today's talk, I'm going to address some of those changes, and we'll just begin with a quick run through of how the virus has impacted global bond markets. And having spoken about that, we'll then talk about the overwhelming fiscal and monetary responses that the global bond market has experienced from the governments and from the regulators, in response to this. Now, I will not really talk about the virus itself. There is no time in today's talk for that. I'm sure you're following what is happening with the hundreds of companies that are looking for a cure or a vaccine, with the changes in the global economy that have been brought about, and in many cases, very distressing drops in employment and production that have been caused by the virus. But instead of speaking about that, I'm going to speak about something that I think fewer people are talking about, which is what has happened to the market structure and liquidity as a result of the coronavirus crisis. The crisis revealed some deep fault lines that I think are going to haunt us in the future. And it revealed that some of the markets that we thought were the most liquid markets in the world really didn't have that liquidity. So, and then we will bring all this together, and I'll tell you where I think this market is going, the global bond market. I'm not going to speak very much about the Indian bond market, but wherever possible, I have included India in the charts so that you can see where India lies with respect to both the emerging and other developed countries, to see where India lies in that spectrum in terms of the responses to the virus. And I'm going to conclude by talking a little bit about the global need for alternative safe investments to fixed income, because one of the biggest consequences we're going to talk about here is the fact that after the virus, a lot of interest rates have come down. And so yields of fixed income bonds are the lowest that they've ever been. And many parts of the developed world now have negative yield. So we really need to think about, as investors, what we should do next to our fixed income allocations. So without further ado, let us start with where the coronavirus has affected global bonds. So if we look at the global economy, we had an incredible contraction of GDP of about 15% as a result of the virus. This is much bigger hit than the 2008 crisis. And because of this hit, the GDP levels that we experienced in 2019 probably will not be reached again until at least 2022, probably later. But in spite of that enormous hit, what we are seeing in terms of bounce back of activities and resumption of somewhat normal life in many parts of the world is that consumers are quite eager for that normalcy. But the fact that people want to go back to normal doesn't automatically imply they can, because they're relying upon an economic revival, and that economic revival depends upon the virus and the progress made against the virus, as well as the other institutions that prop up the economy, the structure of the financial system, as well as the structure of Main Street has to remain intact. But because of the disruption, that's not guaranteed. But nevertheless, I think we are seeing some green shoots here. We are seeing some pickup in activity. And I think that we are going to see a significant bounce because PMIs in May and June globally went up quite a bit. And also, I think that we saw that in retail sales in the US. So there's been quite a significant resurgence in the last month or so. And the stock market actually anticipated that. So we'll see in a minute that the stock market has bounced a lot. Let's talk here about interest rates. So the world of interest rates has had a tremendous shock as a result of the COVID vaccine. We have had big rallies in those countries that started off with higher rates. So the US was the foremost among them. And as you can see, we went from yields of 2% or thereabouts, all the way down to about 0.5% to 0.75% on the 10-year. On the other hand, Germany and Japan, whose yields had already been at or below zero, didn't move as much. You also see that blip that occurred right around March when the COVID crisis hit. I'll talk to you more about that. That was a sudden loss of liquidity in the bond markets. India, as you can see, is somewhere in between here. After an initial reaction, Indian bond yields have behaved very well in response to the crisis. Now, of all of the global G10 yields, the major ones, only the US has provided a significant offsetting positive return to the shock of the negative return in equity markets. So once again, the safe haven status of US treasuries was proven to be a good one, and it actually worked in the case of this crisis. Unfortunately, given where yields are, it's unlikely to be able to repeat that if we have another shock. The curves in the US steepened. They were among the about almost as flat as they had been over a very long period of time prior to this. But still, the new steepness of the US curve, as you can see in this chart, it is now significantly steeper than before the crisis, but not steep by historical standards. And something similar has happened in other parts of the G10 curves as well. Real rates are actually now negative in all of the major developed regions, including the US. So this is a change from before the crisis. Prior to the crisis, Europe and Japan had negative real rates as well as negative nominal rates. And the US, however, had slightly positive real rates, but now after the rally, that's no longer the case. So let us talk a little bit about credit markets here. You can see that the COVID crisis was a shock to credit markets, just as it was to equity markets. The changes in spreads across these markets were roughly proportional to the starting spread. So basically, you can see that every market widened proportionally. And this is very classic behavior for spread markets. Here I'm showing you a range of credit ratings all the way from single A out to single B. And you can see that all of them, after widening initially, are now on their way back. There was also a massive loss of liquidity, which we'll talk about, but it was immediately mitigated by the Fed's QE and liquidity injections. And that helped the spread markets to come back. And they are now about halfway back from the peak to the pre-crisis levels. There are pockets of credit concerns though, and actually there are significant industries such as travel, leisure, commercial real estate that are expected to have significant problems over the course of the next year or two in the US. And similar problems will occur in other parts of the world as well. So the COVID crisis is not over with respect to the fundamentals for credit. And I think you should expect to see some fallout from that. But because the spreads that you're seeing in the market are significantly higher than they used to be, there's probably adequate compensation in many cases for those spreads for investors. So I do expect, for example, that sovereign spreads, as well as in emerging markets, as well as corporate spreads in the US, will ultimately produce positive returns in excess of risk-free rates over the next couple of years. I'm not going to spend a lot of time on equities. I just want to make the remark that although equities have been more like a rubber ball that bounced pretty strongly, there are big differences between different areas. And technology growth stocks, for example, have led the way back. And now they are at levels that are significantly higher than pre-crisis. Whereas, for example, small cap value has been lagging. And similarly, US large cap has led the rest of the world with respect to the equity rally. Emerging markets have had a bit of good news. Here we are looking at the rates in emerging markets, and the world of emerging markets is kind of split into two parts. There's Asia, and then there's the rest of emerging markets. So in the case of Asia, starting with China, there was a very muted response to the coronavirus crisis in rates. They were very well behaved, and actually, in most cases, you cannot even see enough to call the changes that happened in March and April a crisis. But in contrast, the riskier countries in the world, led by Latin America, but also countries like Turkey and South Africa, had pretty significant interruptions to their bond markets. They lost liquidity and the yields went up initially. But afterwards, all of them have stabilized at levels that are below the peaks, as you can see. India, if you have to put it in one of those two categories, I would put it in the first category. Indian bond markets behave very well, and I would describe them as being distinctly Asian in terms of their response to the COVID crisis. I think that the massive injections of liquidity, as well as the fiscal responses by countries around the world, had a lot to do with the fact that these bond markets have stabilized. As I'll show you in a minute, there have been significant outflows from emerging markets in terms of capital flows. But in spite of that, you can see that the domestic bond markets have actually held in really well. The world of currencies, just as with interest rates, have actually fallen into two worlds. Developed currencies behave like safe havens, and they remained really stable. Down at the bottom, you can see that the euro and the yen have not really budged very much, and the dollar, the euro, and the yen remain currencies of choice, with a few wiggles around the time of the COVID crisis. On the other hand, emerging currencies have acted like a safety valve, and they sold off in a big way against the dollar and other major currencies. But after selling off initially, just like with the rates market, the currency markets have stabilized somewhat. Now, the central banks around the world are obviously not happy about the huge sell-off in their currencies, but because it was a deflationary shock, these sell-offs in currencies are unlikely to cause a big spike in inflation and force central banks to raise rates in a cycle that spirals out of control. Rather, I think that what we are seeing here is primarily an economic shock as opposed to a market-induced cycle that leads to a lot of problems. But the fact that these currencies are now a lot cheaper than they used to be is a mixed blessing. For countries that have significant export markets, it'll be a plus. But for countries that need to import, standards of living are going to suffer from this. And countries with a big debt burden denominated in foreign currencies are going to have some issues. As I mentioned earlier, global authorities in countries and regulators responded with a lot of shock and awe. So let us start with the fiscal. So the fiscal measures are shown in the chart on the bottom left-hand side. And they total up to more than $9 trillion around the world if you add up the developed as well as the emerging countries measures. The US alone passed several bills, including a $2.3 trillion CARES Act in response to the virus. And in Europe, we had a similar response, which added up to more than $2 trillion. On the bottom left, you can see that there are blue bars and red bars. The red bars represent outright revenue measures, spending measures, whereas the blue bars represent loans and guarantees. And you can see from the responses here that countries like Italy and Germany, the European countries have preferred to use loans and guarantees, whereas the US, with its profligacy and its tendency to spend a lot of money, has preferred to use outright spending. So, but the combination of these measures has been quite powerful so far, and I think we have not done with that yet. I think we're going to see quite a lot more. On the monetary side, on the right-hand side, you can see how central bank balance sheets have risen very sharply. And that's one out of three things that central banks did. The other two things were basically to lower rates whenever possible and to inject liquidity into the bond markets and into the money markets. So the Fed, for example, cut rates by 150 basis points to 0, and it established 9 new liquidity facilities and started a brand new QE program, adding a whole bunch of different kinds of bonds to its balance sheet. Similar measures from the BOJ and the ECB. And it is all the shock and awe that has allowed markets to price in a recovery and to get ahead of what the economy is actually telling us, which is that the recovery is starting, but it's nowhere near as strong as what the markets seem to be expecting. In the case of emerging markets, the story was a little bit less happy. So you can see that, however, the rates response was pretty significant and across the board. So 74 out of 97 emerging market countries that the IMF tracks actually were able to cut rates this year, which is a remarkable occurrence because historically during the course of crises, emerging market countries are not able to cut rates. They typically are forced to raise rates in order to prevent the kind of capital flows that you're seeing on the bottom right-hand side. So it's not in this case as if those capital flows did not occur, but the deflationary shock that accompanied the virus was significant, and it allowed the central banks to lower rates in the domestic bond markets. In this way, the banks were prevented or were saved from having to raise rates at the wrong time. And historically, this has been one of the issues for emerging markets, that they're not able to do what is right for the domestic economy because they're too dependent upon foreign capital flows. But as you can see, despite approximately $100 billion leaving the emerging market economies, these flows, which would have been very significant 20 years ago, are now a smaller portion of emerging market economies. And the bond markets in EM are now much less dependent on foreigners. And because of the lessons learned from prior crises, the bond markets were able to avert a lot of the problems that they might have had otherwise. And they have largely stabilized. I don't want to minimize the issues that emerging bond markets have, though. We are probably going to see significant distress in Africa and Latin America because the COVID crisis itself has not fully played out. And many of those countries are much poorer credits than where they started from. The drop in the price of oil and commodity prices have also hurt commodity exporting economies. But as we proceed, and we are still writing the chapters of the story, emerging market central banks and governments are continuing to evaluate what further measures they need to take. And so far, I think that the response to the crisis has been pretty good. The IMF has set aside approximately $100 billion, which really, honestly, to me, feels like a drop in the bucket because it's really not adequate, to help even a handful of countries if they got into trouble. So it reflects the decreasing importance of the IMF in international capital flows and in preventing crises. I now want to turn to what happened during the course of the crisis to bond market liquidity around the world. And I'll show it to you in three pieces. We have in the US, as you all know, one of the most liquid markets in the world when it comes to money markets, bond markets, and credit markets. But what this COVID crisis revealed is that these markets were a lot less liquid than we had previously thought. In fact, during this crisis, they showed themselves to have a lot of fragility. The bottom left-hand chart shows you that prime money market funds had a huge outflow compared to government funds. So there was a huge flight to safety. And as a result of that flight to safety, 1 month and 3 month commercial paper, the rates for those for that commercial paper shot up. And the funding spreads of different kinds, LIBOR to OIS, for example, as shown in the third chart, spiked as well. So as a result of this, issuance of commercial paper plummeted in March and April. And many private credit corporations that rely on commercial paper to fund their regular activities found themselves unable to do so, and issuance fell very sharply. Spread product liquidity completely evaporated during the crisis. So major segments of the bond market stopped trading completely. And a big culprit in this were the dealers, the liquidity providers, the banks. When people came to them to trade, they basically refused to trade on principle. They would only trade on agency. In other words, if you and I, you had a bond to buy and I had that same bond to sell, they would cross us and make the bid-offer spread. That's the blue line on the bottom left-hand chart. But if either of us went to them and asked them to be the counterparty, they basically refused or charged such high bid-offer spreads that the transactions were not taking place. As a result, bond market transactions plummeted. And during the period of the crisis, as the chart on the bottom right-hand side shows, actually dealers reduced their inventory of bonds instead of increasing it. This is not the expected outcome from a regulator's point of view when you want an orderly market that continues to work during a crisis, and you really did not get that. What saved the situation was the Fed. So the Fed stepped in, the ECB stepped in Europe and provided all kinds of liquidity facilities as well as QE. And that stabilized the market in a very short period of time. So as you can see, both the bid-offer spreads on the left-hand side as well as the dealer inventories on the right-hand side went up sharply once confidence was restored on the part of the Fed. Now, I don't want to blame all of this on the banks and the brokers. In fact, I believe that at least a portion of the reason for this lies in the regulatory regime and the risk management frameworks that have been imposed since the 2008 crisis. And dealers have been telling me in conversations that this played a pretty big role in their inability to step in. Even if they wanted to, they found a very cheap bond that somebody was trying to sell at a bargain basement price. They were not in a position to buy it during the course of the crisis. Even US Treasuries experienced a major liquidity episode. And this actually spooked the Fed a lot and may have contributed to the extent of the shock and awe that we saw with which they responded to the crisis. In fact, off the run, on the run base differences in yield, which are shown on the bottom left, as well as the difference between Treasury prices and Treasury future prices, which are shown on the right, both indicated that the Treasury market also lost liquidity. Both these problems were also fixed when the Fed came back into the market with quantitative easing and liquidity measures. So that's a quick summary of what happened in the bond markets. What I'd like to turn my attention to here is the future. So what can we expect from the global bond markets over the course of the next couple of years? Well, I'll start off by admitting that all of us have more questions than we have answers to this right now. But I think that certain things are pretty clear. The first is that the yield of the most of the countries, developed countries, government bonds is below 1%. So this is a chart which shows that if you add up all of the developed country government bonds and chart them by yield, then as you can see on the bottom left, the vast majority of them now yield less than 1%. As a reference point, you can see where the US 10-year is at 0.66, and a very small sliver of them are above 1%. Not a small contributor, but a pretty significant contributor to this is the fact that these bonds are now increasingly owned by the domestic central bank itself, or they are owned by domestic banks. So on the bottom right, you can see that in the case of Japan, which has been in the state now for over 10 years, 60+% of the bond market is owned either by domestic banks or by the DOJ. ECB is getting there, and I think that over the course of the next 10 years, we are going to see the same thing start to happen in the US as well. This so-called Japanification of the US, where US yields drop significantly, has an economic component and it has a policy component. So the convergence here of the US towards other major developed regions is probably a major theme of the post-COVID era. And it's really bad news for investors all around the world, because the safe haven security, which used to be extremely liquid and which offered significant yields that were higher than inflation, has been replaced by a security which doesn't have very much rallying room going down to zero. And it is also a security which is exposed to a lot of issuance, because I think, should expect to see US deficits to remain really high. So you'll see a lot of the fiscal shock that we saw before paid for through issuance. And as we'll talk about in a minute, probably some inflation as well. And finally, to put icing on the cake, real yields are negative across the board. So of course, big chunks of the market are already negative in nominal terms. So we have more than $5 trillion of bonds in Japan and Europe that are yielding negative nominal yields. But in real terms, not just Japan and Europe, but the US also has joined that group. Now, we all know that in the case of fixed income, the yield that you start from tells you a lot about what your return is going to be. It's not like equities, where you have no idea what the returns of equities would be over the next few years. In the case of bonds, as you can see on the bottom left-hand chart, as a historical illustration, which shows like the last 100 years or so of yields and the subsequent return after 5 years. Those two numbers are very close to each other. And based on where yields are today, you can see on the bottom right-hand side that you can expect absolutely abysmal returns from most of the major segments of the bond markets, between 0.1% and 0.5% in most cases. The US 30-year is one of the exceptions to the rule, and so it's one of the areas that we actually like still. But in places like Japan and Germany, those yields are negative, and so will the returns be. Now, India looks like a bright spot here with 5.8% in yield, but inflation in India had picked up prior to COVID. So for that return to be meaningful in India, you would still need inflation to be kept under control, which is a question mark. So that's the state of government bond markets. And this has actually created the impetus for the reach for yield to continue. So for many, many years, we've had a global reach for yield. And that reach for yield essentially translated into demand for corporates and for high yield, et cetera. After this huge volatility that we saw earlier in the presentation, in spreads, you could ask the question, will there still be demand for those products? Underneath that are credit problems in industries like transportation. But in spite of those fundamental problems, and in spite of the volatility that we saw earlier in the year, our expectation is that we are actually going to have more of a global reach for yield, basically because the opportunity set in government bonds has been reduced so dramatically. So we have, at the same time, a huge amount of central bank liquidity that's entered the global markets, and that's looking for a place to go. The drop in risk-free rates leaves you with very few options. You still have the same global aging population and is still looking for safe income, and growth is being hurt. So safe havens will be in demand. So for all these reasons, I expect that the reach for yield is going to continue. But when you reach for yield, what are you really getting? This is a chart that shows you that, and this is really a pre-crisis chart. So things are even worse here. But what we see from this chart is on the x-axis, you see the correlation to stocks. And on the y-axis, you see the yield. By looking at the correspondence, the close correspondence between these in many, many sectors of the fixed income market, you can conclude that when you get a lot of yield from any segment in the fixed income market, it typically comes along with an unpleasant side effect, which is that your bond is going to behave a lot more like a stock. And the further to the right you go on this axis in order to pick up more yield, the more vulnerable you are to such correspondence. In other words, the particular thing that you're trying to get away from when you buy bonds, which is stock market risk, is the precise thing that you pick up when you try to get extra income out of it. So this is a problem that has been exacerbated even more after the government bonds, which are shown on the bottom left-hand side of this chart, have had the massive rally that they've had in the course of the last 3 months. And what about inflation? So in the case of the bond markets in the developed world, we expect the initial shock to be deflationary. And I think the same thing is going to be true for most of the emerging markets, in spite of the currency sell-offs that we've had there, because COVID represents such a massive shock to demand. And as you can see, the actual inflation shocks, which are shown on the right-hand side, are initially quite negative. On the left-hand side, you can see, however, that the 10-year inflation index securities yields have kept on dropping, even though the bond market has stabilized, which actually means that after bottoming out, the break-even inflation rate has gone up for the last few months, and is now in the US hovering around 1.5%, which is at the bottom of, but within the range, historical range of 1.5% to 2% where it had been. So something about the markets is actually calling for inflation to go back up again. And that is the pricing in, of course, of the recovery. But it's also pricing in the fact that you've had a significant and unprecedented size of QE. You're going to have large fiscal deficits to cover the relief measures. And because you now have fiat currencies around the world with lots of latitude, the central banks are now able to use the currency as a tool. So the expectation of financial assets devaluing relative to physical assets, which is just a fancy way of saying that you're going to have asset inflation, is a reality. The question of whether or not that translates to price inflation is a very interesting one. I think the risks of price inflation, however, have gone up a bit. I'm not going to suggest that we're going to have runaway inflation in the next few years, but I think the risk of higher rather than lower inflation has gone up. And the major reason why is the populist politics that we see around the world. So populism takes many forms, and you can't make blanket statements about it. But historically, you have seen that whenever you get a regime which is populist in nature, they tend to use inflation as one of their tools. And it is really a tool of redistribution. You can see this happen in the bottom left-hand chart where populist regimes on the x-axis are the ones on the left-hand side. And this is a period in the 70s and 80s when we had problems with hyperinflation in many Latin American economies. The inflation is shown here on the y-axis. In the US, the purchasing power of the dollar has, over the last 80 years, starting from 1940, typically fallen by approximately 40% every 20 years. The last 20 years, however, were an exception, where we only had about a 20% drop in the purchasing power of the dollar. It would not be totally shocking or surprising if we went back to something closer to the historical norm and the dollar depreciated by something closer to 40, in the next 20 years. If that should happen, it would be a disaster, because you can see that the 10-year US, for example, only gives you 0.6%. So 40% devaluation over 20 years with only 0.6% a year being made up by the yield is going to result in a significant erosion of purchasing power. Populism takes many forms. Modern monetary theory is a major example of that in recent times. And inflation transfers wealth from savers to spenders in an insidious way. So I think that governments will be quite tempted to use this mechanism in the years to come. So to summarize the outlook for the markets, we expect interest rates to remain very subdued. The outlook for growth, the fact that it's not going to come back anytime soon, is going to keep the long end of the curve down, even though in the very near term, the US 10-year could easily have a sell-off and the curve could steepen. If it does, then the 10-year could jump into the 1+ range. That's a risk. But if it does, I think it will subside fairly quickly back again into the 0.5% to 1% range. Credit, I'm fairly constructive given where spreads still are and the fact that you've had significant QE and the Fed stands behind and the ECB stands behind the bond markets. High yield defaults will spike. They'll be 10% or more in 2021. But spreads are sufficiently wide to compensate for that. And there's quite a lot of value in fallen angels. In the case of the emerging market countries, I think that there's room for some of those countries to cut further. So for example, Mexico, China, Russia, the bond markets there still have value. And on average, yields of 400+ basis points over US Treasuries make that one of the sectors in the world that are likely to do well without getting into a credit market. And finally, I think the US dollar is going to remain bid for quite some time. But if you look in the long term, I would expect that the US dollar will slowly turn to weakness as the low rates combined with deficits of both kinds, the current account deficits as well as fiscal deficits, create weakness in the dollar. But for that to actually occur, I think you need a significant recovery from the coronavirus. So this brings me to my final point, which is that we expect a significant change in the characteristics and nature of global fixed income. We have a $100 trillion problem here. Low nominal yields, negative real yields around the world imply extremely poor returns for investors who have been told that they need to put 40% of their money in bonds. There's a very opaque market structure in fixed income. And as we saw in the examples earlier, it is exposed to the kind of episodic liquidity, illiquidity that we saw in the coronavirus crisis. There's a lot of lack of transparency and instruments are really fragmented. Spread products are very complex and risk correlated, so you can get yield, but then you're really buying equity market risk. And there is some evidence that you can actually replicate many spread products by combining equities with government bonds. So you're really not getting that much new when you buy spread products as a whole. Individual spread products, individual credits actually give you some diversification, but they have to be chosen carefully, and fees in the fixed income market are too high for the yields that they offer. And last but not least, inflation is a problem in many parts of the world, if not immediately, because the coronavirus is going to be deflationary, then in the longer term. So all of these problems lead to the need for a alternative solution, which probably needs to be constructed from asset classes other than fixed income. And this is the goal of my new startup. We are putting together low volatility strategies from multiple asset classes, doing our quantitative homework to control for risk, and using highly automated and liquid assets in order to make the solution scalable. For policymakers, there are lessons as well. The first of those is it may be time to create a more direct lending and crowdsourcing type of credit market to cut out a lot of the middle layers that have added to fees in the fixed income market, given that yields can no longer support those fees. There is, I think, an opportunity here to broaden trading and data accessibility to make credit much more transparent and make it more similar to equities, to reduce the number of intermediaries, to increase transparency and bring issuers closer to investors, and to revive structured credit. This is a controversial recommendation after what happened in 2008 with structured credit. But I think with careful regulation, structured credit is a significant source of potential decently yielding and relatively safe investments that, if applied in a broad way to the assets around the world, could potentially help to solve the problems. So with that, let me conclude. To summarize, the global recovery will be slow, rates will be low, real returns of most government bonds and cash will be negative. The reach for yield is going to intensify, and the outlook for spread products is constructive because they're wide enough, to give you some return for investment. We do expect deflation near term, but inflation is a future risk, which is slightly higher now than it was before the crisis. It's not my base case, but I think there's a good chance of it's increasing from previous levels. Ultimately, 2 to 3 years out, not right now. And finally, there is a critical unmet need for an alternative to fixed income in the form of safe investments. And with that, I want to thank you and hand it back to Jayan.
Thank you, Dr. Rajan, for that insightful presentation. You've kind of covered well across the length and breadth of the globe, or others. We went around the world with you. Whatever else are different central banks are working towards to maintaining market stability and still maintaining a funding line open for as many as possible corporate, mid-market, small market clients, individual clients, retailers, so on. Before I get into a question answer, dear my friends on listening into the webinar, I have few housekeeping points to share with you. Please put in your feedback that's open up in the evaluation survey before you sign off today. Further, this particular webinar participation does have certain credits, CEs, as we all know. So please do claim professional learning credit by logging in onto your online professional learning tracking tool. And finally, I thank you, Dr. Rajan, once again for giving us insightful presentation, and I will open the floor for Q&A. While your presentation was on, I had a couple of them running in my mind, and I would like to pose them for your opinion, your feedback. What would you advise the Reserve Management rooms of various emerging market countries, including India? What should they do with their reserve investment policy? That's my opening question, and I would like to believe that you, in your new avatar, have a lot of guidance being given through your new avatar, new startup, in advising large money managers, large institutions. So may I hear your views for, let's say, reserve management.
Yes, thank you. Yes. Just to recap, the central banks in emerging markets did spend some dollars during the course of the crisis. They were forced to because there was a tremendous capital flight. There was about $100 billion or so that left emerging market countries in the form of capital. And when that happened, they were forced to use some of those reserves to fund the outflows. So when someone wants to take money out of the country and they want their dollars, there's not very much that you can do other than give it to them. However, you can use your currency as a tool. So you can allow your currency to depreciate somewhat and mitigate the effects of those capital flows. If the currency is cheap enough and it doesn't cause a spiral, then people will stop taking their money out. And that has indeed happened. So the capital outflows that we saw between March and June have actually stabilized. So careful calibration of in what cases you allow the currency to depreciate in response to demand for dollars, and in what cases do you allow do you defend the currency and prevent a disorderly depreciation by allowing that capital flight to occur is a central question for emerging market central banks. And for the most part, they have actually answered that question in a very competent way. So emerging market central banks are not what they used to be 10 or 20 years ago. They're run by really competent people. And you can see the quality of that. Of that management in the handling of this crisis. That doesn't mean that the problems in terms of reserves are over. Now, what was helpful in the COVID crisis was the level of reserves. So over the course of the last 10 to 20 years, a number of central banks had built up something of the order of $13 trillion of reserves in the form of dollars. The problem that arose was primarily one of short-term liquidity, and the Fed stepped in with swap lines to help many of those central banks to handle that. I think going forward, you should not expect to see the same extent of urgency in terms of the need for liquidity, and the existing swap line should be able to handle that. So given the immediate crisis has passed and future flows are likely to be more gradual, my recommendation to central banks is basically to allow the currencies to take the brunt of the damage if there is further outflow, rather than using additional reserves to defend. Because I think those reserves will come in handy. We have not necessarily seen the end of this. And I think that prudent reserve management would call for you to use the currency as a safety valve rather than expend the remaining reserves that you have in order to defend it. And that'll also put you in a better competitive position going forward if the currency devaluation is orderly and you end up in a spot where you can actually rebuild your competitive advantage in the post-COVID.
Thank you, Dr. Rajan. Switching track and still continuing to seek your feedback in the current times or in the new post-COVID normal times, would you look India having issuing the first of its international bond issue in the international markets? Do you think that's likely to happen?
I think the case for that is improved. Because, assuming we get through the actual COVID crisis and that things return to a semblance of normalcy in international sovereign markets, the fact that yields have dropped so much means that India can issue in dollars at very attractive yields. And I think that'll continue to be the case. The spreads at which India can issue may have gone up a little bit, because of the deterioration in the credit rating. So that'll have to be watched. But I think that establishing a benchmark from the government, is a useful thing to do, not because the Indian government really needs dollars. That's not really the reason. It's in order to allow the private sector to be able to have a benchmark for its own dollar raise. So I've always been a fan of having liquid benchmarks against which people can judge credit quality. And I think that having the Indian government establish such a benchmark will do two things. One is it'll send a signal back to the Indian government that they need to do fiscal, keep fiscal under control and be prudent there in order to keep those yields at levels that are attractive for the Indian economy. And two is going to make investors, if assuming that the first condition is met, it'll make investors realize that India is a pretty safe place in which to lend. And it's one of the steps that's required to deepen and broaden Indian debt capital markets going forward.
Thank you, Dr. Rajan. Few more questions, but before that, I'm looking into a lot of questions that have come from our friends who've been attending your presentation. Let me pick few of them and pose them these queries off to you. Again, given India, specifically about India, where already the gross deficits of both state and central at a very high number. Yes. Locally, what you would expect the Indian borrowing program to continue sustain, the outlook for Indian inflation, and therefore outlook for fixed rates, interest rates for India. For your comment, Dr. Rajan.
I think that one should not judge the future of interest rates based on what happens during the course of a crisis. It's a little bit like advising family to conserve water during the time that their bedroom is on fire. Water conservation is a really good and laudable goal and should be returned to at the point where it's appropriate. So I think it's really easy for outsiders to sit there and say, you should do this and you should do that. At the end of the day, governments have to do what they have to do in order to bring populations back to normalcy. And I think that should be the first goal. Having said that, I think it's the preparation prior to crises that allows you to do a better job during crises. So if, for example, there were more fiscal room, and by the way, I'm not going to target India here in this comment. I think everything I'm saying applies equally to the US, for example. The fact that we never got our fiscal house under control in the US is going to contribute, I think, to dollar weakness going forward. It's going to contribute to a fiscal deficit, and it may contribute to inflation. And I think that these are issues that are really agency issues and they're time horizon issues. The problem with governments around the world is that they have to appease their audiences in the near term, whereas in many cases you have to act for the long term in order to set up the stage where you're able to handle problems when they arise in the future. Many governments are really not well set up to do that. In the case of the US, for example, both the Republican and the Democratic Party have given up any semblance of fiscal conservatism. In India, there's been an endemic problem, which is because of the structure as much as people. It's not just individuals, it's also the system itself, which promotes deficits. I think that once the crisis is past, a really good look should be taken at that. And I think that there's enough brain power in India many times over to solve this problem. So you don't need my advice on this. It's simply a matter of deciding to put your own house back in order.
A question that comes up is the US elections, which are around 4 months from now, 5 months from now. Yeah, Dr. Rajan?
Yes.
Yeah, the question about the US elections that are due in next 4 months, 5 months. Should the change of power move from Republicans to Democrats?
if it should move from Republicans to Democrats, and I missed the second part of your
Oh
question.
yeah, how and what should the government change in USA? Do you
Uh,
expect the policies to have a different outlook?
yeah, I think the nature of government spending will change, but the extent of government spending probably doesn't change very much. So, uh, as I said earlier, the Republicans have really changed in their stance on spending. They used to be the party that was much more reluctant, to spend. And I think that over the years, all of that has changed as the party itself has become more populist. Having said that, the things that Republicans spend on are different from the things that Democrats spend on. The Republicans spend on defense. The Republicans are much more willing to spend on agricultural subsidies. They typically will be happy to bail out corporations. So they spend a lot of money on those things. The Democrats, when they come into power, will scale those things back. And instead, they're going to do a lot of spending on social programs and make up for, 4 years of Trump. Which one will be worse from a fiscal standpoint? It's hard to say, but I don't think you should expect to see fiscal deficits in the US coming back under 3% for many, many years. So that's the fiscal answer. I mean, there are many big differences, obviously, in policy platforms between the two parties. Probably an entire webinar could be devoted to that. And I'm not the guy that you want to do that for you.
We are about to, I mean, there are many more questions, but I'll club a few of them into last two questions from my side. And before I pose these questions, one more housekeeping reminder to all our participants on the call to complete their evaluation survey that you see in the chat box, with the link is in the chat box, and also log in and complete your professional learning credit by logging into your system. Last couple of questions, Dr. Rajan, and again from our participants. A specific question has come up about outlook on TIPS, the Treasury inflation securities, in coming times,
Yeah.
with the recovery that is expected in next calendar year.
So I really liked TIPS about 2 or 3 months ago. There was a period, as I showed you in one of the charts in the presentation, there was quite a very sharp reversal, in break-even yields. Break-even yields had gone really, break-even inflation, had dropped quite dramatically during the crisis. But it has been creeping up ever since, and it's back to 1.5%, which tells you that the bond market not only expects a recovery, which is part of the reason for that, but it's also expecting a lot more inflation than it did a couple of months back. And so that inflation over a 10-year period will have to exceed 1.5% for you to do well with your investment. But you already know what I think about this. I do believe that there is a significant risk that inflation will increase, but for the reasons that I outlined in the article. So at 1.5%, which is at the bottom end of the 1.5 to 2 year range, I think TIPS represent fair value. So they are not, I don't think that they are too expensive here. Having said that, you may get an opportunity if we get a significant delay in the recovery, which is quite likely that we'll have setbacks here. We've been in a pretty euphoric state, and markets have been pricing in a pretty strong recovery here. If we get a fallback in that, you will undoubtedly get a fallback in that inflation break-even point as well, and that may represent a better entry point, for those tips.
Actually, you kind of broached in the last comment. There was another question which says, how does one correlate or reconcile rather in a dropped or such low interest rate environment, that in search for returns, currently the asset classes are they forming a bubble? Asset classes, stock markets and bonds. It's difficult to reconcile with such syndrome?
Mhm.
What do you
So I
care
wrote
on
a
this? Yeah.
and you guys can find that on my website, which is www.basispointglobal.com, actually saying that we have a bubble going on. But it's not a broad bubble across all financial assets. It's a bubble specifically in tech growth stocks. So, as you guys probably know, the FANGs, the Facebook, Apple, Amazon, Google, and Microsoft complex has been expanding at a much faster rate in terms of valuations compared to the rest of the stock market. The growth segment of the um, technology industry and the healthcare industry has led this recovery, and the spreads between that and everything else, small cap stocks, value stocks, international stocks, all of those have lagged significantly behind this particular group. And you have individual examples like Nikola and Zoom, which tell you that there is something really strange going on. And I think the coronavirus has actually inflated this bubble. Now, you had the bubble going on before. This is happening already for the last couple of years, but it's been accelerated by the virus because the fiscal and the monetary stimulus has to go somewhere. It's heading into this. People are sitting at home, and there's a significant retail component to the bubble in many individual stocks as they day trade, even as they are working from home. The third element of this is that people are running away from other sectors like commercial real estate, and they're running away from transportation industry and other places. They have to put their capital somewhere, and this is a natural target for it. So all these different reasons why the coronavirus is actually made, and perhaps most importantly, structurally, the global economy has realized that we are virtualizing our world. We're going to a technology-driven world where we don't have to leave our home to have a webinar like this. The fact that we are doing that actually has boosted all these stocks. So I think that there is, of course, a strong, good fundamental reason for these stocks to increase. But remember that that's how bubbles always are. Bubbles don't start from areas where there's no fundamentals. The fundamentals always support bubbles. It's just that the valuations get way ahead of those fundamentals. And to know where they are with respect to where they could be, is really an art. And you know that, but it's extremely useful to be aware that you're in the middle of one. Across other assets, I don't really see a bubble. What you see in the case of the global bond markets is a risk that the deflationary environment that has now been priced in across all these developed market bond markets is at risk from inflation and from a change in the regime where ideas like monetary theory, modern monetary theory, gain credence. And if that should happen over the course of the next few years, bonds would be an even worse investment than what they already appear to be, which is right now they just look like they're going to be low yielding but very stable. But if some of these risks come to bear, then you'd actually lose capital as well. So I think that that's a potential problem. I'm quite nervous about that risk. Again, I don't want to make this a base case. I'm just telling you that, the fact that valuations are so rich across the board in developed markets makes them relatively unattractive investments in the long run.
Thank you, Dr. Rajan. Thank you very much. And with that, we would be closing the today's proceedings. I too have got few more questions, but that I will post over LinkedIn or email to you. And to all our participants who have been on this session for last 70 minutes, 72 minutes, thank you for your patience hearing and going through the presentation of Dr. Rajan that he painstakingly made over last few days. specifically for our group, for our friends. And last but not the least, please recollect your, remember the housekeeping issues, complete your evaluation survey. And with that, I would be closing this webinar. Uh, Dr. Rajan, thank you. And friends on the webinar, please look at the event calendar of CFA Society for next events.
Let me just add that I want to thank you, Jain, for moderating the session and for your kind words, and to all of you for coming. And it's always a pleasure to address the CFA Society of India, and it's no different this time. Thank you very much.
Closing the webinar. Thank you, friends.